Good morning. Welcome to Sound Money Management on Connect FM. I am Jay Philippone with the legendary Chuck Johnson, and we are here to help you with your investing life. So, if you listened last week, we started a great lesson on 8 metrics that you can use to pinpoint higher probability stocks for your portfolio. Now, that emphasized that no one single metric or group of metrics can guarantee success, and that's why we call it investing and not earning. So today we're going to look at the final 4. And before we get to that, Chuck, I just want to remind people, if they want to hear that show from last week, they can hear it at connectradio.fm.
Yes, they can. And you can go to our webpage, guardianplanners.com, and we also have links to the show. You can actually see my smiling face. We are doing video podcasts as well. And I'll talk about getting those up on the Connect site. Maybe.
We can do that.
We'll
put them up on tricounty.tv.
See how that works. Yeah, maybe.
Yeah.
We'll have to see how that would work. We started a great show. By the way, just since we're on the subject, please do go to Guardian Planners Facebook page, like and follow, and you'll get updates to our podcasts and all of the things that we're doing. So, yeah, eight metrics that you can use to pinpoint higher probability stocks for your portfolio. And we did emphasize that no one metric or group of metrics can guarantee success. But again, I always get a little annoyed when somebody tells me, they want to know what I do for a living, and I tell them, oh, you're a professional gambler. No, not really. If you want to use that analogy, I'm a casino. I'm the house. I want to be the house, right? The house isn't gambling. The house is playing the odds. And is a popular movie from years ago, May the Odds Always Be in Your Favor. What was that? Mockingjay? What was that movie? Hunger Games.
Hunger Games. All right, there we go.
Yeah. May the odds ever be in your favor. And that's what you want to do when you're investing. You can't guarantee that a stock is going to rise. Nobody can. You can't guarantee that a gambler coming into your casino isn't going to win occasionally. That's why they keep coming back. Right? But the house always wins. The house has all these employees, you see, and they have real estate taxes and utilities, and the owners, they definitely want to make a profit. So when you play those games of chance, just know that the house has a better chance of winning than you do. And that's how you want to do your investing. You want to be the house. I reject that it's gambling if it's done properly. Now, some people gamble.
Well, there is one big difference in my opinion, a lot of difference. One big one.
Okay.
You have a lot of research. I've seen it. I'm surprised your eyes don't cross. But when you go to the card table or the slot machine, there is no research.
There's no research. That's true. And there are some investors that go that way, like the people, that jumped into the IPO.
Mm-hmm.
Now we're going to have to beep that out, aren't we, Al? I can't mention stocks, Jay. So some people who jumped into a recent IPO, I can say that.
You can.
Just because of the hype. So somebody wins at a slot machine and people crowd around to play other machines in that area, maybe. It's just, so you can absolutely gamble, absolutely, with your investing. But if you do it properly, if you're serious about it, and realize that all the games are rigged to slightly favor the house, slightly, right? And that's a critical element of investing. You don't have to win 90% of the time to be a successful investor. If you manage risk well and win 50% of the time, even 40% of the time, you can win 40% of the time if you're managing risk well and still be a successful investor. It's a lot of people don't understand. So let's take a quick review of our first 4 metrics. So the question you want to ask is the business growing? It's the first question. And the metric that you use to determine that is revenue growth. Is the revenue growing? And as we go through these, remember that it's more about a trend. You want to see a trend in that. It's, in other words, one great year of growth doesn't really mean a whole lot if the previous years weren't growing as well. And also, you have to stay industry specific. You can't compare real estate investments with tech company investments. It's different. It's
Now, do you judge it on percentages or dollars?
percentages.
Percentages.
Yeah,
Okay.
percentages. Um, Although some people use a dollar as a baseline. Maybe I don't want to invest in a company that's worth less than $100 million because then you're, penny stocks. You got to be careful with that. But yeah, generally it's percentages. Is the business growing? So you're looking at revenue growth. The other question is, are profits growing too? Because a business can be growing but not making any money. And the metric you look for there is earnings per share growth. And again, if you want the further details on these, we really went into depth last week, so you can go to Connect FM's podcast site. You can also go to Guardian Planners, and
We're everywhere.
we're everywhere. Our YouTube page also has the video. So anyway, third question: is management efficient? So for that, you look at return on equity, and is the balance sheet healthy? And that is the debt to equity. Again, make sure you're staying industry specific. You are comparing apples to apples.
Hmm.
You don't want to be looking at a high growth tech stock and comparing that to, say, a blue chip company that's been around, for 100 years. Not the same comparison. Um,
And so for these four metrics, they're not hard to find, right? You don't have to have fancy software. You can pretty much find them when you research a company online.
Google it.
Google it.
Yeah, I mean, yeah,
And there you go.
you Google it, and most financial sites that you go to, even the free ones,
Hmm.
have all of this information. It's funny, what you can get for free is quite a bit.
Hmm.
We pay a lot of money at Guardian Planners for our data stuff. It's worth it. It's absolutely worth it. But yeah, all this stuff, if you want to do some basic research, you can get all of this stuff. So again, that's the first layer of stock screening. But I want to remind and re-emphasize these important principles. Again, no single metric tells the whole story. If you find yourself focusing in on one thing, like earnings per share is a big one. That's a huge one. People always throw that around. Well, they compare the earnings per share of what they want to invest in with the earnings per share of the S&P 500 in general. So, well, the EPS is less than the S&P EPS, so it must be a bargain. Yeah, maybe, maybe not. Maybe that's your first screening step. You're looking for undervalued, and that might be how you define undervalued. But if that is the key metric, if that's the only thing you're looking at, you're not being the house. You're just being a gambler, right? A company can have incredible growth, but too much debt, right? So you have to dig a little deeper. So they're growing, leaps and bounds. Boy, I wish I could mention companies and stocks because there's some great examples out there. But
And that's one of your big things when you look at the market overall, isn't it? Debt.
I hate companies that carry too much debt. That is sometimes necessary.
Yes.
And we shared last week about how some companies like to boost their earnings per share. One way to do that is, well, let's reduce the number of shares outstanding. Here's something people don't understand, and I don't think I covered it last week. A company borrows money to buy back shares. So if they have 100 shares and the company earns $100, that's $1 per share. EPS
Hmm.
is $1. Well, let's say the CEO's bonus is based on increasing earnings per share, and the chief financial officer comes and says, "Hey, boss, we're going to be slightly negative. We're only going to come in at 90 cents per share. We only earn $90, not $100." And the CEO says, "That's not good. So, do we have any cash on hand? No, not really, not a lot. Okay, so let's go take a loan, and we're going to buy back 60 percent of our shares. So now we only
Wow.
have 40 shares outstanding, earning $90, and our earnings per share all of a sudden is like $1.75." Right. So I increased earnings per share. Where's my bonus? You loaded the company with debt. See, when a company buys back its shares,
Hmm.
they're removed from the market. They don't count in the earnings per share calculation. So it's just like they disappear.
Good way to check the stock price.
It is a good way. Yeah. And a lot of companies did this years ago. That was a thing. So, yeah, you got to look at debt. And another might have little debt. It seems like they're managing well, but the sales are shrinking. So successful investing is usually about finding businesses where several quality indicators align, not chasing one impressive statistic. Remember to look at trends. One year doesn't make up the whole, the
Hmm.
whole picture. So, all right. So that's our roundup. Coming up, our final four metrics and how I think you should use them. We'll be right back.